Riverbed Technology, the inside track that led nowhere. In July 2023, private equity firm Vector Capital acquired Riverbed Technology for an undisclosed price. The company that once commanded a $3.6 billion valuation in 2015, just 8 years earlier, was now being absorbed by a rescue investor. Riverbed didn't collapse. It didn't go bankrupt. It simply disappeared into the portfolio of a firm that buys broken things. The question isn't whether Riverbed failed. The question is, how did a company that invented an entire product category end up being quietly liquidated by Wall Street? The story starts in May 2002. Jerry Kennelly and Steve McCanne founded what they called NBT Technology, Next Big Thing, in Redwood City, California. They renamed it Riverbed in 2003. Their first product was the SteelHead appliance, shipped in April 2004 to Environment Canada. What was it? A box that sat between office networks and the internet. It compressed data, cached files, and optimized traffic so that remote workers could actually get their jobs done across slow, expensive WAN connections, wide area networks. This was not a small problem. By 2006, when Riverbed went public on NASDAQ, enterprises were drowning in branch office inefficiency. Riverbed owned the category they'd created. The stock markets noticed. The company IPO'd in 2006. Then came the acquisition carousel. In February 2009, Riverbed bought Mazu Networks for their traffic analysis software. In October 2010, they acquired Case Technologies, which made network analysis tools. They bought Zeus Technology in July 2011 for load balancing software. By 2014, they'd become a sprawling portfolio company: WAN optimization, application performance management, network visibility, data backup products called SteelStore. That same year, Elliott Management Corporation made a $3.36 billion acquisition offer. Riverbed's board rejected it. In December 2014, Thoma Bravo and Teachers Private Capital acquired Riverbed for $3.6 billion, roughly the same valuation Elliott had offered months earlier. That acquisition closed in April 2015. Here's where the timeline becomes important. Riverbed went from public company to private equity hands. And from that moment forward, every CEO announcement reads like a fire sale. Jerry Kennelly, the co-founder, retired in April 2018. Paul Mountford became CEO. Then Rich McBee in October 2019. Then Dan Smoot in June 2021. 3 CEOs in less than 3 years. In December 2021, Apollo Global Management recapitalized the company, a polite term meaning Thoma Bravo cashed out and handed the wreckage to another PE firm. Then Vector Capital bought it in July 2023. 5 different leadership regimes in 8 years tells you something was broken that new executives couldn't fix. But here's the detail that reframes everything: Riverbed's fundamental problem wasn't competition. It was irrelevance. By 2015, when they went private, the technology landscape had already shifted. Cloud adoption was accelerating. Software-defined networking was emerging. And most critically, bandwidth was getting cheaper and more reliable. The entire economic justification for WAN optimization boxes was evaporating. Thoma Bravo knew this. They didn't buy Riverbed because they believed in SteelHead appliances. They bought it because private equity firms buy companies with recurring revenue and established customer bases, strip out costs, and harvest cash. The acquisition at $3.6 billion wasn't a bet on growth. It was a harvesting operation. In June 2019, Riverbed announced it would resell Versa Networks' SD-WAN products, meaning Riverbed wasn't building the future of networking anymore. They were reselling someone else's future. In October 2019, they sold Xeris, their wireless division, to Cambium Networks. That's not diversification. That's liquidation disguised as portfolio optimization. The real story isn't that Riverbed failed to innovate. It's that Riverbed was bought by the kind of investors who don't care about innovation, they care about extracting value from an aging cash cow until there's nothing left to extract. 3 CEOs in 3 years weren't trying to save the company. They were trying different strategies to keep the bleeding slow enough that the PE firm could exit without a total loss. The lesson is this: being acquired by private equity isn't a rescue. It's a different kind of ending. When a company with a real product category, something Riverbed genuinely invented, gets bought not by a strategic competitor or a larger tech company, but by a financial engineering firm, what you're watching is the conversion of innovation into spreadsheets. The technology doesn't disappear overnight. But the forward momentum does. And once that stops, it's only a matter of time before someone like Vector Capital buys the corpse at a discount. Riverbed didn't lose to better technology. It lost to a business model that was older than the internet itself: borrow money, acquire cash-generating assets, minimize investment, and extract returns. By that logic, Riverbed didn't fail. It just became irrelevant.